Look, let's take a quick look at the charts because it does help to illustrate what we're talking about. So just to illustrate, we are just recording this on Wednesday, the 26th, and that is just before, about half an hour before the pit opens. And there's some additional volatility at this point because the Chancellor in this country is just, and here's where we opened. It now requires over $1,550 more to buy the same ounce of gold. And from where we opened in 2025, over $23 more fiat to buy the same ounce of.
In today's rapidly shifting precious metals environment, understanding real-time chart behavior has become essential for interpreting deeper market trends. Andrew Maguire highlights that even a quick review of the charts can reveal structural movements that traditional commentary often overlooks. The recording is made on Wednesday the 26th, just 30 minutes before the pit opens, a moment when institutional activity typically shapes the early direction of markets. Added to this is the Chancellor's budget announcement, injecting short-term volatility into currencies and interest rate expectations. Together, these conditions create a meaningful backdrop for observing how gold and silver react when liquidity, policy decisions, and investor sentiment converge all at once. As the data unfolds, Andrew Maguire stresses that the year's opening price levels act as a vital benchmark for measuring the scale of the current revaluation. What might appear as a routine upward move in gold is, in truth, a sign of deeper stresses embedded in the global financial system. The cost of buying the same ounce of physical gold has risen by over $1,550 this year, an extraordinary shift within such a limited period. Compounding this is the Federal Reserve's decision to maintain interest rates between 4.25% and 4.5%, a stance that continues to pressure fiat currencies while strengthening the appeal of physical assets. These developments point to tightening liquidity conditions, heightened institutional interest, and growing competition for physical bullion, all of which reflect a market adjusting to long-term monetary and sovereign risks. Silver mirrors this trend with equal clarity. Since early 2025, acquiring an ounce of physical silver now requires over $23 more, a strong indication that demand is consistently outpacing available supply. According to Andrew Maguire, these price movements are not temporary spikes but signs of a broader repricing driven by persistent structural pressures. Gold and silver are reasserting themselves as reliable stores of value during periods of economic uncertainty, and the charts offer a clear, evidence-based picture of this ongoing transition. Before we dive deeper into the analysis, click subscribe and activate notifications to stay updated with every important market development.
Look, let's take a quick look at the charts because it does help to illustrate what we're talking about. So just to illustrate, we are just recording this on Wednesday, the 26th, and that is just before, about half an hour before the pit opens. And there's some additional volatility at this point because the Chancellor in this country is just making their budget statement. So we would expect a little bit of volatility around that. Now, in the bigger picture, we're drawing closer to the end of 2025. And to illustrate just how well physical gold and silver has acted as wealth protections since we opened this year, and here's where we opened, it now requires over $1,550 more to buy the same ounce of gold. And from where we opened in 2025, over $23 more fiat to buy the same ounce of silver. Now, what we're doing is reaffirming and in real time updating where we see these fiat to physical balance points as we move forward. Now, whereas it seemed a stretch at the beginning of the year to extrapolate the $2,900 opening price to $4,500, which was our original projection, now we've got lots of company with almost every single bullion bank looking at $4,500 to $5,000 gold in 2026. And bearing in mind, 2026 begins in just 5 weeks, and we're in sync with our very same reliable liquidity providers who are assessing a doubling of the gold price by the end of 2026. Now, we'll be tracking this closely and sharing this along the way. Now, the largest part of the move will be driven by a sudden lack of supply as Western institutional actors now seeking to move to a 40-20-20 allocation to gold from zero allocations increasingly competes with the inelastic central bank demand, where it will at best estimate require $8,000 gold, just scroll down, to bring sufficient bullion to the market to meet this enormous demand. There is insufficient physical to meet this enormous inflow of demand. And not to leave silver out of the equation, as we've said before, the best consensus is $80 silver, and that is in the shorter term, not in further out, which really anticipate somewhere in the region of $140 to $200. So what we look at here is for stackers to be able to shake off the smoke and mirrors legacy market shackles and to join forces with every single central bank and sovereign investor now racing to exchange their rapidly debasing fiat currencies, treasuries, for real world zero counterparty risk bullion. There simply isn't enough above ground bullion to meet this demand at current prices. That's true for both gold and silver. So let's start with the first clue, the unprecedented backwardations. This is an action call and a massive opportunity to front run the next leg higher. Futures market backwardations to spot. What they do is telegraph the legacy December gold and silver futures prices, which we've just been tracking, have been physically mispriced. Now, hang on. This is the largest the largest price setting futures exchange globally. Paper futures, cash settled. So basically these December contracts, which everyone looks to for a reference, have been physically mispriced. And while the spot market is influenced by these diluted prices influencing the local London fixes, where deliverable bullion can be sourced, because it's diluted with synthetically generated, unbacked 96% leverage COMEX supply, the exponentially larger global facing T+1 deliverable, i.e. must be delivered under Basel III compliance rules. Anything that turns up at the fix must be T+1 deliverable, 1 day deliverable physically. So these T+1 spot market fixes, they ultimately determine a global market deliverable price. And it's
in recent market observations, Andrew Maguire emphasizes that the persistent backwardations between futures and spot pricing illustrate a critical structural mispricing within the global precious metals markets. The December futures contracts, traditionally considered the benchmark, have repeatedly failed to reflect the true physical conditions because they remain heavily diluted by unbacked, synthetic COMEX supply operating at nearly 96% leverage. As Andrew Maguire explains, this distortion masks the real-time tightness in the physical market, where deliverable metal under Basel III standards must settle on a strict T+1 basis. Such regulatory requirements expose a widening gap between artificially suppressed paper valuations and the genuine cost of acquiring vaulted, deliverable bullion. This divergence becomes even more critical as institutional portfolios shift rapidly from negligible gold allocations toward the emerging 40/20/20 model, directly competing with persistent, inelastic central bank demand. According to Andrew Maguire, the accelerating supply imbalance will ultimately require dramatically higher prices, potentially $8,000 gold and $80 silver, to draw sufficient physical bullion into the market. The unprecedented backwardations therefore act as a forward-looking signal, highlighting a rare opportunity for informed participants to position ahead of what may become a supply-driven revaluation cycle.
But here's the point, from a higher support level. It is these so-called balance points that we're actually tracking and sharing with you. Now, we've been tracking this same chart for the whole of 2025. So essentially, Stepping back to look at the sequence of higher physically supported stair steps commencing the moment the BIS reclassified gold as a first-tier asset class on the 1st of January 2023. In fact, they front-ran that by clearing all their 500 tons of derivative bets, buying them all back before the 1st of January, and they did that in November of 2024, which really sent the message that if you should be getting out of Dodge if you're short. So when we step back and look at it, the picture becomes much clearer. And we're tracking the spot chart here. But when we think about it, out of the 600 to 800 tons of unallocated gold cleared daily amongst the LBMA member banks, the books of the banks, there's only ever 3 to 5 tons of actual NSFR compliant gold offered at the fixes. And what that has done is prolong the official price capping efforts. Now, with only a tiny percentage of FX gold ever being offered at the fixes, Beijing moved to consolidate its position as the physical global price setting hub, opening up physically backed, and this is, if you remember this was the moment the Shanghai Futures Exchange traded on the 1st of March 2024, absolutely blindsiding every single commercial who had been, or the house, shall we say, what we call the COTs, the commercials, who were really acting on behalf of the Fed as well, and very, very profitably doing so over the years. Now, here is where this launched. And what was notable, this was the exact moment the physical liquidity spigot opened up, forcing thousands of tons of T+0 physical bullion bars to be sourced out of synthetically underpriced global stocks. Now, given that each bar has to be fully paid for before being offered for sale, a real supply-demand price began to emerge. And that is what is going on. And it is not driven by the West anymore. Also, it did not go unnoticed that the PBOC simultaneously reaffirmed its long-standing gold support mandate. Now, this unassailable mandate to back the yuan with gold stretched back all the way to 2010 in one form or another. Now it's in your face. So this was in 2010 was when China opened up and encouraged citizens to invest in gold. And then more recently, opening up access for smaller investors to be able to buy and save in gold with a click of a mouse. At every gold monetizing, de-dollarizing stage along this way, citizens were told that these RMB priced investments would appreciate solely based on a rising gold price. And that has been assured and has been maintained. Not only does this monetize gold as the perfect wealth protection hedge into the world's largest saving rate of 43% of disposable income, it doesn't take much investment in gold from billions of people to invest a little bit in gold here or there to really affect the prices. So what we're saying is, though, silver is quilling for a physically settled rally spring, is what we're saying. Now, we've been month after month drawing attention to the Office of the Comptroller report, where the quarterly report really started to illustrate that every single bullion bank that had been short gold and silver had removed their 5-year and further out bets short. And that was telling us they were scrambling to short cover. Now, bearing in mind that these bets, these OCC bets in gold, they can essentially, there's enough gold to actually for the BIS, the Fed, to repay their BIS bets sequentially higher and higher and higher. And it looks like once again going to end up into Friday. And we would expect a little bit of capping into the shortened Friday session as they try and close this BIS bets without getting any further deeper in the hole. But essentially, the Fed have to repay these Bank of International Settlements bets. Now, a lot of these A lot of this liquidity lives in the Office of the Comptroller bets, which are really unallocated FX gold and silver bets. Now, while the Fed can print money to buy gold, and that drives the gold price higher, not so in silver. There simply isn't enough silver for the LPMCL to even source. It just simply isn't there. No matter how many dollars you print, you simply cannot buy the bullion. We're talking a huge amount of a short position that is impossible to cover. Hence, the realization that to bring sufficient silver to market to actually meet this forced short covering demand is going to require a minimum of $80 an ounce. This is a huge misstep by the Fed. And with the Fed, their agent LPMCL, the four banks that have really managed to contain and act on behalf of them in silver, the liquidity, as demonstrated by backwardations, the liquidity has fractured. It's just not there anymore. Also, following 39 tons of COMEX gold deliveries so far already taken out of the vaults, net of rollovers into the February contract, there's still 128 tons of gold warrants still open. And liquidity providers expect large forced EFP deliveries.
The broader precious metals landscape is undergoing a structural transition driven by tightening physical supply, rising global demand, and the accelerating shift of price discovery toward Asia. Since gold was reclassified as a first-tier asset, a clear sequence of higher, physically supported levels has emerged, reflecting genuine liquidity rather than synthetic pricing. Beijing's expansion of physically backed trading and its long-standing mandate to support gold have further solidified its role as the new anchor of global price setting. Meanwhile, Western markets continue to struggle with limited NSFR-compliant metal, persistent backwardations, and an inability to source sufficient bullion, particularly in silver. How can a market defend short positions when the underlying asset simply isn't available? With banks unwinding long-dated shorts and supply fractures becoming undeniable, both gold and silver appear positioned for a significant revaluation. If you found this helpful, please like the video and leave a comment with your thoughts. Don't forget to subscribe and turn on the bell so you get notified about our latest updates. Thanks for watching.